Welcome. Today, we're diving into how economic indicators shape investment decisions. Whether you're a seasoned investor or just starting out, understanding these indicators is crucial. They provide valuable insights into the health of an economy, helping you make informed choices. Throughout this video, we'll break down key indicators, explain their significance, and show how they influence where and when to invest. Let's get started by exploring what economic indicators actually are and why they matter so much in the world of finance. Economic indicators are statistics about economic activities. They help investors gauge the current and future health of an economy. These indicators come in various forms, such as employment rates, inflation, and GDP growth. By analyzing these numbers, investors can anticipate market trends and adjust their strategies accordingly. Understanding the basics of economic indicators is the first step toward making smarter investment decisions. Next, let's look at the main types of economic indicators you'll encounter. Economic indicators are generally categorized into three types: leading, lagging, and coincident. Leading indicators predict future economic activity, lagging indicators confirm trends, and coincident indicators move in line with the economy. Each type serves a unique purpose in investment analysis. By recognizing which category an indicator falls into, investors can better interpret its message and adjust their portfolios accordingly. Let's explore each type in more detail, starting with leading indicators. Leading indicators are economic factors that tend to change before the economy as a whole changes. Examples include stock market returns, new business startups, and consumer confidence indexes. Investors closely watch these indicators because they can signal upcoming shifts in economic activity. By acting on these early signals, investors can position themselves ahead of market trends, potentially maximizing returns. Next, let's see how lagging indicators play a different role. Lagging indicators reflect changes that have already occurred in the economy. They confirm patterns and trends that leading indicators may have predicted. Common lagging indicators include unemployment rates and corporate profits. While they don't predict future movements, they help investors validate their strategies and understand the effectiveness of past decisions. Now, let's move on to coincident indicators and their significance. Coincident indicators move in tandem with the overall economy. They provide real-time snapshots of economic health. Examples include GDP, industrial production, and retail sales. Investors use these indicators to assess current conditions and make timely decisions. By monitoring coincident indicators, you can stay updated on the economy's present state and adjust your investment approach as needed. Let's now explore some of the most influential economic indicators in detail. Gross domestic product, or GDP, measures the total value of goods and services produced in a country. It's one of the most widely used indicators to gauge economic strength. A rising GDP typically signals a growing economy, which can boost investor confidence. Conversely, a declining GDP may indicate economic trouble ahead. Investors often use GDP trends to decide whether to enter or exit certain markets. Next, let's examine the role of inflation in investment decisions. Inflation represents the rate at which prices for goods and services rise. Moderate inflation is a sign of a healthy economy, but high inflation can erode purchasing power and reduce investment returns. Investors monitor inflation closely to protect their portfolios. Central banks often adjust interest rates in response to inflation, which can impact stock and bond markets. Let's look at how interest rates themselves serve as a key economic indicator. Interest rates set by central banks influence borrowing costs and investment returns. Lower rates can stimulate economic activity by making loans cheaper, while higher rates can slow growth. Investors watch interest rate trends to anticipate changes in market conditions. For example, rising rates may make bonds more attractive, while falling rates can boost stock prices. Next, let's discuss how unemployment rates factor into investment decisions. Unemployment rate measures the percentage of people actively seeking work but unable to find jobs. High unemployment can signal economic distress, while low unemployment suggests a robust economy. Investors use this indicator to gauge consumer spending power and overall economic stability. Changes in unemployment rates can influence stock prices and guide investment strategies. Now, let's turn our attention to consumer confidence and its impact. Consumer confidence index measures how optimistic or pessimistic consumers are about the economy's future. High confidence often leads to increased spending, which can drive economic growth and boost company profits. Investors monitor this index to predict shifts in consumer behavior and adjust their portfolios accordingly. A sudden drop in confidence may signal trouble ahead, prompting more cautious investment strategies. Next, let's examine the importance of retail sales data. Retail sales data tracks the total receipts of retail stores. It's a direct measure of consumer spending, which is a major driver of economic growth. Rising retail sales can signal a healthy economy and encourage investment in consumer-focused companies. Conversely, declining sales may prompt investors to reconsider their positions. By keeping an eye on retail sales, investors can spot emerging trends and make timely decisions. Let's move on to industrial production. Industrial production measures the output of factories, mines, and utilities. It reflects the strength of the manufacturing sector, which is closely tied to economic performance. Investors use this indicator to assess the health of industries and anticipate changes in demand for raw materials and finished goods. A rise in industrial production often signals economic expansion, while a decline may indicate a slowdown. Next, let's discuss the significance of housing starts. Housing starts refer to the number of new residential construction projects begun in a given period. This indicator provides insights into the health of the real estate market and the broader economy. Strong housing starts often signal economic growth, as they boost demand for materials, labor, and related industries. Investors watch this data to identify opportunities in construction, real estate, and home improvement sectors. Let's now look at the Purchasing Managers Index. Purchasing Managers Index, or PMI, surveys business leaders about new orders, production, and employment. A PMI above 50 indicates expansion, while below 50 signals contraction. Investors use PMI data to gauge business sentiment and anticipate economic shifts. Changes in PMI can affect stock prices, especially in manufacturing and service sectors. Next, let's discuss how balance of trade figures influence investment decision. Balance of trade measures the difference between a country's exports and imports. A positive balance or surplus can strengthen a nation's currency and attract foreign investment. A negative balance or deficit may weaken the currency and deter investment. Investors monitor trade balances to assess currency risks and identify global opportunities. Let's now explore how government fiscal policy can impact investment decision. Fiscal policy involves government spending and taxation decisions. Expansionary fiscal policy, such as increased spending or tax cuts, can stimulate economic growth and boost investor confidence. Conversely, contractionary policy may slow growth. Investors pay close attention to fiscal policy announcements, as they can influence market conditions and sector performance. Next, let's discuss the role of monetary policy in shaping investment strategy. Monetary policy, managed by central banks, involves controlling the money supply and interest rates. Expansionary monetary policy can lower interest rates and encourage borrowing, while contractionary policy can do the opposite. Investors track monetary policy to anticipate changes in market liquidity and asset prices. Policy shifts can create opportunities or risks, depending on the direction of change. Let's now look at how exchange rates affect investment decision. Exchange rates determine the value of one currency relative to another. Fluctuations in exchange rates can impact the profitability of international investments. A strong domestic currency can make foreign assets cheaper, while a weak currency can boost returns on overseas investments. Investors monitor exchange rates to manage currency risk and optimize global portfolios. Next, let's discuss the impact of commodity prices on investment decision. Commodity prices, such as oil, gold, and agricultural products, can significantly affect investment returns. Rising commodity prices may benefit producers but hurt consumers in certain industries. Investors track these prices to anticipate sector performance and adjust their portfolios. Changes in commodity prices can also signal broader economic trends, such as inflation or global demand shifts. Let's now explore the role of stock market indices as economic indicator. Stock market indices, like the S&P 500 or Dow Jones, reflect the performance of a group of stocks. They serve as barometers for overall market sentiment and economic health. Investors use these indices to track trends, compare returns, and make allocation decisions. Sudden movements in indices can signal shifts in investor confidence or economic outlook. Next, let's discuss the importance of bond yields in investment analysis. Bond yields represent the return investors receive from holding government or corporate bonds. Rising yields can indicate expectations of higher inflation or stronger economic growth, while falling yields may signal caution or economic slowdown. Investors watch bond yields to assess risk, forecast interest rate changes, and balance their portfolios. Let's now look at how credit ratings influence investment decision. Credit ratings assess the creditworthiness of governments and corporations. High ratings suggest low risk, while low ratings indicate higher risk. Investors use credit ratings to evaluate the safety of bonds and other fixed income investments. Changes in credit ratings can affect borrowing costs and influence investment flows. Next, let's discuss the significance of business inventories as an economic indicator. Business inventories track the amount of goods companies have in stock. Rising inventories may indicate slowing demand, while declining inventories can signal strong sales. Investors monitor inventory levels to anticipate changes in production and sales trends. This information helps them identify potential opportunities or risks in various sectors. Let's now explore the impact of wage growth on investment decision. Wage growth measures the rate at which workers' pay increases over time. Strong wage growth can boost consumer spending and corporate profits, while weak growth may signal economic challenges. Investors track wage data to assess the potential for increased demand and inflation. Changes in wage growth can influence stock prices and sector performance. Next, let's discuss the role of government debt as an economic indicator. Government debt measures the total amount a country owes to creditors. High debt levels can raise concerns about fiscal sustainability and impact interest rates. Investors monitor government debt to assess risks and opportunities in bond markets. Changes in debt levels can influence currency values and overall market sentiment. Let's now look at how demographic trends affect investment decision. Demographic trends, such as population growth and aging, can shape long-term investment opportunities. A growing population may boost demand for housing, education, and consumer goods, while an aging population can affect healthcare and retirement sectors. Investors analyze demographic data to identify emerging markets and sectors with growth potential. Next, let's discuss the importance of technological innovation as an economic indicator. Technological innovation drives productivity and economic growth. Advances in technology can create new industries, disrupt existing ones, and open up fresh investment opportunities. Investors watch for trends in research and development, patent filings, and tech adoption rates. By staying ahead of technological changes, investors can position themselves for long-term success. Let's now explore the impact of global events on economic indicator. Global events such as geopolitical tensions, pandemics, or natural disasters can significantly impact economic indicators. These events may disrupt supply chains, alter consumer behavior, and shift market sentiment. Investors must stay informed about global developments to manage risks and seize opportunities. Monitoring how economic indicators respond to global events helps investors adapt their strategy. Next, let's discuss the role of market sentiment in investment decisions. Market sentiment reflects the overall mood of investors. It's influenced by news, economic data, and global events. Positive sentiment can drive markets higher, while negative sentiment may lead to sell-offs. Investors use sentiment analysis tools to gauge crowd behavior and anticipate market movements. Understanding sentiment helps investors avoid emotional decisions and stick to their strategies. Let's now look at how to interpret multiple indicators together. No single economic indicator tells the whole story. Savvy investors look at a combination of indicators to get a comprehensive view of the economy. By analyzing trends across GDP, inflation, employment, and other metrics, investors can make more balanced decisions. This holistic approach reduces the risk of relying on misleading signals. Next, let's discuss the importance of historical data in investment analysis. Historical data provides context for current economic indicators. By comparing present figures with past trends, investors can identify cycles and patterns. This helps in forecasting future movements and avoiding common pitfalls. Historical analysis also reveals how markets have responded to similar conditions in the past. Let's now explore the limitations of economic indicators in investment decision. While economic indicators are valuable tools, they have limitations. Data can be revised, delayed, or misinterpreted. External shocks and unpredictable events can render indicators less reliable. Investors must use indicators as part of a broader strategy, combining them with qualitative analysis and risk management. Understanding these limitations helps investors avoid over-reliance on any single metric. Next, let's discuss the importance of diversification in investment portfolios. Diversification involves spreading investments across different asset classes, sectors, and regions. This reduces risk and enhances the potential for stable returns. Economic indicators can guide diversification decisions by highlighting sectors or regions with strong growth prospects. By diversifying, investors can better weather market volatility and achieve long-term goals. Let's now look at the role of professional advice in investment decision. Professional financial advisors can help interpret economic indicators and tailor investment strategies to individual needs. They bring expertise, experience, and access to advanced tools. Working with an advisor can help investors avoid common mistakes and stay disciplined. Advisors also keep clients informed about changes in economic conditions and market trends. Next, let's discuss the importance of ongoing education for investors. Investment landscape is constantly evolving. Ongoing education helps investors stay updated on new economic indicators, market trends, and investment products. By learning continuously, investors can adapt to changes and make better decisions. Educational resources include books, courses, webinars, and financial news. Let's now look at how technology is transforming investment analysis. Technology has revolutionized how investors analyze economic indicators. Advanced software, data analytics, and artificial intelligence enable faster and more accurate analysis. Investors can now access real-time data, automate portfolio management, and use predictive models. Embracing technology helps investors gain a competitive edge and respond quickly to market changes. Next, let's discuss the importance of emotional discipline in investing. Emotional discipline is key to successful investing. Economic indicators can trigger strong reactions, but it's important to stick to your strategy and avoid impulsive decisions. Investors who remain calm and focused are better equipped to navigate market volatility. Developing emotional discipline takes practice, but it pays off in the long run. Let's now look at how to set clear investment goals. Clear investment goals provide direction and purpose. Whether you're saving for retirement, a home, or education, defining your objectives helps guide your decisions. Economic indicators can inform your strategy, but your goals should remain the foundation. Regularly reviewing and adjusting your goals ensures they stay aligned with your financial situation and market conditions. Next, let's discuss the importance of regular portfolio reviews. Regularly reviewing your investment portfolio helps ensure it remains aligned with your goals and market conditions. Economic indicators can signal when adjustments are needed. By monitoring performance and rebalancing as necessary, investors can optimize returns and manage risk. Scheduled reviews also help identify new opportunities and address potential issues early. Let's now look at the importance of patience in investing. Patience is a vital trait for successful investors. Economic indicators can cause short-term market swings, but long-term trends often matter more. Staying patient allows investments to grow and compound over time. Reacting hastily to every data release can lead to poor decisions. By focusing on long-term goals and maintaining discipline, investors can achieve better outcomes. Next, let's discuss the importance of risk management. Risk management involves identifying, assessing, and mitigating potential losses. Economic indicators can help highlight risks, but investors must also consider their own risk tolerance and financial situation. Using stop-loss orders, diversification, and insurance are common risk management strategies. By proactively managing risk, investors can protect their portfolios and achieve more consistent results. Let's now look at the importance of staying informed. Staying informed about economic indicators, market trends, and global events is crucial for making sound investment decisions. Regularly reading financial news reports and analysis helps investors stay ahead of changes. Being well-informed enables timely adjustments and reduces the risk of surprises. Let's now summarize the key takeaways from our discussion on economic indicators and investment decision. Economic indicators are powerful tools for investors, offering insights into market conditions and helping guide decisions. By understanding and interpreting these indicators, investors can make more informed choices, manage risks, and pursue their financial goals. Remember, no single indicator is perfect. Use a combination, stay disciplined, and keep learning. Let's wrap up with a final thought on the importance of adaptability in investing. Adaptability is essential for long-term investment success. Economic conditions, indicators, and markets are always evolving. Investors who remain flexible and open to change can better navigate uncertainty and seize new opportunities. By combining knowledge, discipline, and adaptability, you can build a resilient investment strategy that stands the test of time. Thanks for joining us on this journey through economic indicators and investment decision.